Good morning, students. Let us cover the topic of derivatives. We will today start with options. So, students, as you can see that in our previous sessions, we have covered on the forwards and futures, uh, which are the basic level derivatives. Now, today, let us start from the options concept, and then we'll do some of the practical questions. Now, what are options? So, for options, let us first try to understand that what is the definition of these options are. Strictly speaking, options are also of two types, call option and put option. It's better we segregate them and study them differently. Okay. So first, let us see the call option and everything. So what we say is A is a financial contract that gives the right to buy an underlying asset. Okay, something which is underlying. For example, in this case, let's assume X Limited's equity share. Okay, so the right is given to buy that underlying asset, which is an X Limited equity share, for example, at a given price. The price is also given. So you see the kind of specifications that this contract will have at a specific price. That price would also be given. So there is a right to buy an underlying thing at a specific price. Very easy and very simple. This is a very simple contract that A is there. But what we need to understand here is that there is no obligation for him to buy. If he wants, he can buy. If he don't want, he cannot buy because there is no obligation. There is no mandate. He enjoys a right. He enjoys an option. Okay. And also, as we have discussed in derivatives, some standard feature says that every derivative would have a fixed time limit or some kind of expiry attached to it. So this contract will also say that you cannot buy this asset endlessly at a specific price. It will not say like that because otherwise that contract is not valid because contract need to have some kind of a expiry. So there are two kinds of situation with relation to time, I'm saying. One is that it will say that on an agreed date. So this right to buy can be exercised on an agreed date, or it can be up to an agreed date. I hope the difference is visible from these two statements itself. So there is one kind of a option, or there is a one kind of a contract which gives a right option to buy X limited equity share, which is an underlying at a specific price on an agreed date. That is one. This is one type. And second type is up to an agreed date. So from today up to that date, whenever we want, this can be exercised. Okay. So this is called as, in technical terms, call option. This agreement, this contract of A. So basically A is what I'm saying is the A is the basic contract. That A contract is called as call option because it gives the right to buy an underlying asset at a specific price, either up to an agreed date or on an agreed date. Okay, we will elaborate all these things further with proper examples. So, but this is the very first basic understanding. Okay. Now, let us try to see the basic definition first of all for put option also. Okay. Now what this put option says, call. Okay, as the name suggests, call means the person who is holding this will call the shares, will call the underlying. Call means he will try to buy. Hence it is mentioned here as to buy. Correct. Now what does this put means then? So put again, let's say the same A contract, or let me take here B contract because A we have taken above. So this is, let's say, a B contract, which is again a right or an option. Option means I can do this, I cannot do this as per my willingness. Correct. So that is what is called as option. Correct. Because I have an option whether to do this or to do that. I have an option to buy it or not to buy it. Correct. But it's not an obligation, no obligation or no mandate. Now, what kind of right does B gives? It gives the right to sell, to put. Put means I am putting it for selling. Put, to sell. What to sell? This underlying asset, any underlying asset. At what price? At an agreed price. At a predetermined price. At an agreed price. Okay. Now, in this case also, for the time, there can be two situations. One is on an agreed date. So only on that date, the transaction of sell can happen. That is on an agreed date, or up to an agreed date. The same thing that we have studied above. Up to an agreed date. This is what called as put option. Put option means that it gives you the right to sell. Call means it gives you a right to buy. Okay. Now let us try to elaborate this on an agreed and up to an agreed date further. Now students, if you see, let's say today is, let's say, 0 day. Correct. 1 month, 2 months, and then 3 months. This is 1 month, 2 months, 3 months. Okay. Now I'm just focusing on the time limit expiry. Whatever time limit we have discussed here in these two options in both the type of contracts. So here, let's say today on 0 day is the date of entering into the contract. Date of entering into contract. Now, while I say this is a contract, okay, always think in this section of options discussion, contracts, I would be using the term in relation to options only. These both terms interchangeably we will be using. Okay. So date of entering into a contract, which is nothing but an option, correct? Which is nothing but an option, can specify two things, correct? What are those two things? Let's say the tenure of the contract is 3 months. Okay, this is the tenure of 3 months. Now there are two ways how it can be drafted, how this contract can be can take a birth. There are two ways. One is the contract can say anytime up to 3 months, we give him an option to buy or to sell. To buy will be under call option, to sell will be under put option at any point of time. At any time up to 3 months. Don't you think that this is a very good option for a person who is holding it? Because he holds that right currently, which gives him an option to buy or to sell the underlying asset at a specific price at any point of time. Whenever he sees that, okay, there is a price benefit to him, he will execute that and he will exercise the right. So this is one type of the contract which we have also seen above, and this contract is called as, these type of options are called as American options. These are called as American options, which gives the right to exercise at any given point of time up to 3 months. The second type, as we have also seen above, will say that you cannot exercise in between. You have to go till and wait till third month end to execute it, to exercise it. On third month expiry only, which is on a specified date. Okay. Now these type of options are called as European options. These are very standard terminologies that are used, American options and European options. So now if we are discussing anything on American options, then we should know that the option gives the entitlement to exercise the contract at any given point of time up to the expiry. However, European will give only on the specific date. Okay. With this, the discussion on the time limit is closed. Okay. Now let us see the other elements. Now let us go back to the call option. Yeah, this was our call option. Now in the call option, as we said that A is called as call option, correct? Because A gives the right to buy an underlying asset. Underlying asset is also specified because in some of the in one of the features, the standard features of the derivatives, we studied that there are certain things which are certain. One of them is the underlying asset, the quality of that asset, the quantity of that asset, correct? So those things will definitely be specified. Now, how can the specific price also be determined? And what does this called? This is called as strike price. Technically, we call this as strike price. Now, this strike price is the determining factor whether this option will be exercised or not in the time to come. Because if there are certain conditions that is suitable compared to this strike price, which is this at a specific price is strike price only, then only in case of favorable options, then only this will be exercised. We will see that as well. But what I'm trying to say is that strike price plays a very important role in all the decision making, whether to sell it, whether to buy it, what to be done, whether to hold it. So strike price gives a is a very important determining factor. Okay. Similarly, here also, in case of a put option, there is a right to sell at an agreed price, means this is also a strike price, but this is a strike price of a put option. Okay. So this is how the contract is structured, and this is what the difference between call and put option is. Okay. Now, let us also see that parties to the options, who all are the parties to the options. Because till now we have studied that it is kind of a contract, and definitely contract will be between two parties. One in technical term would be the seller and another one would be the buyer. Now seller and buyer of what? So students, if you recall the first class in which we studied what are some standard features of derivatives, we said that buyer and seller of a derivative would be different from the buyer and seller of the underlying. Underlying is happening in a separate market. Correct? Underlying trading is happening in a separate market. And options, futures is happening in a separate market, separate segment of the market. So, sorry. So parties to the options, we are talking about the parties to the derivatives here, not to the parties of underlying. Now, who all are the parties to the options? First of all, students, please note that we are talking about options, and options are the right to buy or right to sell. Now, can I use instead of option, call option or put option, can I use this term right to buy, right to sell? Right to buy in case of call and right to sell in case of put. Correct? Now, the the instrument here that is getting traded is right to buy, not the asset itself, not the underlying itself, right? And here the trading is happening on right to sell, not on the asset itself. Okay, please register these things in the mind, because these things are very critical to understand what is the difference between an option and future. Correct? So here we are just trading in the right to buy. Now for this right to buy, which is a call option, there will be a buyer and there will be a seller. Buyer of what? Buyer of this right to buy. And seller of what? Seller of the right to buy. Seller also of right to buy and buyer also of right to buy. I'm just here putting here not to be confused with the buyer of underlying. We cannot say that he is a buyer of underlying. Similarly here, not to be confused with the seller of underlying. Because here, instead of underlying, what these buyers and sellers are trading, these buyers and sellers are trading right to buy. This is the financial instrument, right to buy, that they are trading. Correct? Similarly, right to sell. Right to sell, also there is a buyer. And right to sell, there is a seller. Now, students, please note, in case of right to buy, the buyer on a future date is going to buy the asset. That is the right to buy. And the seller of right to buy is saying that, okay, you can buy that asset from me. So essentially, the buyer and seller for right to buy remains the buyer and seller on the execution date also. You're getting my point? So what will happen? I'm just elaborating the first point only. On expiration or up to expiration, whatever it is, dependent whether it is European option or an American option, correct? Up to expiration. Now, this buyer is also the buyer of underlying asset. And this seller of right to buy would also become the seller of underlying asset. I hope this is clear, correct? Now, coming to right to sell. Now, a buyer is there for right to sell. That means if I am purchasing a right to sell, That means on expiry or up to expiry, I have a right to sell. Correct. So on expiry or up to expiry, why I'm using both of them in case of European options or in case of American options. On expiry or up to expiry, this buyer will become seller of underlying. See the positions, how it is getting changed. And this seller, since he has sold the right to sell to this buyer, so what does he said that, okay, I am selling you a right to sell, that on expiry, you sell this asset to me. So this seller will become buyer of the underlying asset. Okay. In case of right to sell, which is a put option, correct? This is a put option. The buyer is the one who is purchasing the right to sell. And hence, on execution, once he's executing this right to sell, he will become the seller of the underlying itself. Okay, students, I hope this differentiation of buyer and seller from the perspective of options and from the perspective of underlying asset is very much clear. Please do ask if you have any questions till now. Now we will strengthen this understanding with the help of one example. Okay. So I can also put one more thing here so that all of us are on the same page. Buyer of right. Buyer of right. Okay. Here also seller of right. Here also buyer of right. Again, he's a buyer of right. He's also seller of right. Okay. So here we are talking about buyer and seller of right, not the buyer and seller of underlying, because it will change their position depending whether it is a call option or a put option. Okay. So Harshad is asking, seller will be an individual or a stock exchange? Very good point, Harshad. So seller can be an individual. It will not be a stock exchange, because stock exchange will enable the buyer and seller to do the buying and selling of the right. Okay. So stock exchange will be an intermediary where buyer will go and place the request of buying the right. Seller will go and place the request of selling the right. The seller will be an individual or it can be any other independent authority, not stock exchange. Okay. Also, buyer of the right. Buyer of the right. Now, right is of anything, right? Right to buy or right to sell. I'm not going into that. Buyer of the right is also called as holder of the option. Correct? And seller of the right is also called as writer of the option, because he is writing the option. Writer of the option. I mean, I'm talking here about call and put both. Okay. Here also call and put both, which is right to sell and right to buy. So he's also called as holder of the option because he's holding the option. He's holding the right. He's also called as writer of the option because he has written that option. Okay. Now let us see the next part in this. Now imagine Mr. A and Miss B. Now, what happens? Mr. A purchases a right from Miss B. So, right to buy, for example. Very easy example I'm taking. So, Mr. A purchases right to buy from Miss B. Correct. So, Miss B sells right to buy to Mr. A. So, now Miss B will be the writer and Mr. A will be the holder. Now, if you see from Mr. A's perspective, he has only got the right, correct? He has got the option. He has not been obligated, he is not mandated to enter into the transaction on expiry or up to expiry, whatever it can be. So, Miss B, don't you feel that Miss B's rights are subjudicial, correct? Because what is Miss B that she is getting in return? She is actually giving somebody a right, correct, without taking in return. That is not the case. Miss B will say, I will give you a right. Okay, I will give you a right, but for that right, you have to pay me a premium. You have to pay me a premium because you will enjoy. So, what Miss B will say, okay, Mr. A, you will enjoy certain rights. You will enjoy certain rights which you are going to take benefit of it if there are favorable conditions. And if there are unfavorable conditions, there is at least no loss to you because of this right. Hence, you should give me some premium because I am undertaking that right for you. Hence, I am writer of the right. Okay. Harshad is asking, buyer will pay money and seller will receive money in option or like derivatives, both will pay money. Okay. So, Harshad, that is what I am just clarifying here. Okay. So, Harshad, please pay attention. The money will flow in the form of premium from Mr. A, who is the holder, to writer Miss B, because Miss B has undertaken that risk. What if tomorrow the situations become favorable for Mr. A? Then Miss B have to bear a loss. We will see how. Hence, Miss B will say that, okay, I need to get some premium. Imagine this kind of a contract to a contract that an insurance company does. What does insurance company says that I give you a right to claim. Insurance company says that in case you make a loss, I give you a right to claim. And in return of that, the insurance company expects the holder of that right, correct, to pay some premium. This is what it is. Here in this case, Miss B is actually insuring Mr. A against something. Now, what is that something is what we will see now. Okay. Frankly speaking, this is not an insurance contract. This is a derivative contract only, correct? But I'm just telling you because some of you would think why there is a need to pay a premium. Hence, I'm saying in real life also, the premium is paid once there is some extra right is given to someone else, correct? Then only Mr. A will pay a premium to Miss B. Now, let us pick all the things together and connect the dots with this kind of example. Now, for example, there is a strike price of 110 that is already fixed while any financial instrument on options is created. The first thing that is fixed is strike price and what is the underlying asset. We also know that spot price in the market is 100 rupees as on today. So the spot price is as on today. Strike price of 110 means that let us assume the time period here for 3 months. Let's say this option is for 3 months. I'm assuming that this is a European option. Okay. I'm assuming it is a European option. That means it will be exercised at the end of 3rd month. Okay. So what does this option gives you a right? And the underlying asset is again X limited, I'm saying, correct? So this is the underlying asset. I'm using the short form here, UA. Okay. Now, and first of all, let's talk about call option. Now, if we replace these figures in the first definition that we have studied, it says that the call option will give a right to buy. Okay, I'm just writing it here. The right to buy X Limited's share after 3 months at the rate of 110 per share. This is what the contract will simply say. Okay. Now this is what the contract that will simply say. Right to buy X Limited share after 3 months at the rate of 110 per share. Now again, this is between Mr. A and Miss B that the transaction is happening. I'm saying Miss B is a writer, or she's a seller, and Mr. A is a holder. Okay. Holder means he's holding the right to buy this call option. Now, as of now, the spot price is not relevant for us, correct? Spot price as of now is not relevant for us. We will see how it is relevant in the valuations going forward, correct? So, what we need to know is that, okay, Mr. A will give to Miss B some premium, correct? There is some premium to be paid. Now, how to value this premium is what we will cover in the valuation principles of the premium. Correct. And I can mention here premium as cost of giving right. Simple. This is the cost of giving right. If the right is given from Miss A to Mr. A, so from Miss B to Mr. A, the premium will be paid from Mr. A to Miss B. Now what will happen? Let's say on expiry, okay? On expiry, when is the expiry? After 3 months. On expiry, and I am assuming, let's say the premium to be paid is rupees 10 here, okay? That is rupees 10. So rupees 10 Mr. A have paid to Miss B. Now there can be, I'm taking 3 types of scenarios here on expiry. Scenario 1 is if the price after 3 months, the actual price in the spot market after 3 months is 125. Now see what first of all, let us try to understand from Mr. A's perspective. Mr. A will think that the current spot price is 125. On expiry, I'm telling you. On expiry, Mr. A will say, okay, the current spot price is 125, but I have a right to buy an asset at 100 rupees. Sorry, 110 rupees, because the strike price is 110. Don't you think Mr. A will be very happy? Because in the open market where the people are purchasing the shares of X Limited at 125, Mr. A holds a right to purchase it at 110. So Mr. A will be happy, and this right has proved beneficial to him. These are favorable condition. This I was referring na favorable and unfavorable. This is what the favorable condition is. So Mr. A will be happy because Mr. A can get something what is available in the market at 125. Now he can get 110. So Mr. A would exercise the option. Yes, he would exercise the option because in technical term we call as it is in the money. This option is in the money. Correct? This option is in the money. That means this option is fetching money to the holder. is giving money to the holder. Now, if you see, what is going to happen is Mr. A will now go to Miss B and he will say to Miss B, okay, you give me one share, I will give you 110. This is the gross way of settlement. Or Mr. A would say, okay, you let it be. I don't want the share, but what you do, you give me 15 rupees, which is 125 minus 110. 110 I will put from my own pocket, 15 rupees I will take from you, and 125 rupees I will go in the open market and purchase an equity share. Still, there is a 15 rupees gain to me because from my pocket I have put 110 rupees only. Correct? So in any case, the payoffs will look like this. So there are two ways of settlement here. One is the gross settlement and one is the net settlement. So gross settlement, A will pay 110 and receive one share. Or on net settlement, basically what is going to happen is that Mr. A will receive 15 rupees. That's all. After receiving 15 rupees, he will put 110 from his pocket, go to the open market and purchase a share at 125. Very simple, very easy for case number 1. Okay. Now, what will Miss B think here? Miss B will say, okay, let me put one more thing here. So the net payoff, students, please note, net payoff is how much? Or I can say that the net gain or loss, sorry. So because of this entire arrangement, net gain slash loss is equal to 15 rupees is the gain minus 10 rupees is the premium cost. Because what Mr. A will think, I have already given 10 rupees at the time of inception of this agreement as a cost to you. That was a cost to me, correct? That premium was a cost to me. Hence, I have a net gain of rupees 5. Simple. So the net gain loss is rupees 5. Now for Miss B, the net gain loss is how much? This is a gain, correct? 5 rupees is a gain. Here, 10 rupees would be her income because the premium received by Miss B is income for her, correct? And minus 15 rupees is the cost for her because she have to give this 15 rupees on net settlement. So 5 rupees is a loss here for Miss B. Okay, students. So this is case number 1 where the spot price on expiry, let me say spot price on expiry. Now let's take the second example. Let's say the spot price on expiry is 95 rupees. It can be, we will take 3 examples. One is higher, lower, and at the same price. Now what will happen at this 90, once the spot price goes to 95? Now what Mr. A will say? Mr. A will say, no, this is not an right to me anymore on expiry. Why? Because something which is available in the open market at 95, I have a right to buy at 110. Why I should buy at 110? I will not exercise the option. I will not exercise the right. This is not a right anymore. Correct? Not a right anymore. Hence, it is out of the money. We say this as out of the money. And he will not exercise the option. No exercise. That means gross settlement, nothing will happen. Net settlement, nothing will happen because he is not going to exercise the right. The net gain loss is 10 rupees loss, which is the sunk cost or premium that he has already paid. The premium paid by a holder is always a sunk cost because that is already paid and nothing can be recovered from that now. So there is a 10 rupees loss to him. Okay. What Miss B says here is, Miss B says, okay, I don't have to pay you anything, correct? Because it is out of the money. So whatever 10 rupees I gained, that is a gain to me. Gain rupees 10, simple, which is the premium. So this is from the Miss B's perspective, and this above segment is from Mr. A's perspective. Now let us take the last example. If it is expiring on 110, the spot price is equal to the strike price. Now Mr. A will say that okay, I am neutral to this, whether to exercise or not to exercise. Open market, I am also getting at 110. Here also I am getting at 110. So this is called as at the money, where holder is neutral, actually is neutral to exercise. So nothing will happen here. Even if he exercises also, no payoffs will happen here. The net loss or gain, the net loss or gain is 10 rupees of loss. And here also gain of rupee 10. Okay, students. Now, a very good observation that Harshad has also mentioned. So Harshad Gohil has mentioned, sir, means seller of a call face unlimited loss. Very good. So you are right, because the seller is undertaking the risk, and hence there is no limit to the loss. Tomorrow, if the price instead of 125, it goes to 150, what amount Miss B will have to pay to Mr. A? 40 rupees. 150 minus 110. So the loss will keep on increasing as the price keeps on increasing. And hence, the gain to Mr. A, see, the loss to writer is unlimited. Gain to holder is also unlimited, correct? Even the gain to holder can also be unlimited. If the price is going upwards, the entire amount will come as gain to the holder. Similarly, the gain to writer is limited. This is limited maximum up to the premium. That's all. Max up to premium. Loss to holder is also limited max up to premium. Because holder also will not incur anything apart from the premium cost. Writer also will not gain anything apart from the premium income. Correct? So this is what the correct conclusion is. Okay, students? Now let us try to see fit the same example in case it is a put option. Again, let's take the same thing. Strike price 110. Spot price current 100. Okay. Strike price 110, spot price 100. X limited is the underlying security. 3 months is the time period. Okay. 110, 100, 3 months is the time period. And this is what we are talking about, the put option. Again, Mr. A is holding the right to sell. Miss B has written or has sold the right to sell. Correct? Because put option is right to sell. Now see students, what will happen next? Let us say on expiry, spot price on expiry will again be classified into three main buckets. First of all, let us see the bucket of 95, 110 and 125. I'm putting the same values here so that we can compare both call and put option on the same prices. So in case the spot price comes as 95, now Mr. A will think what? Mr. A will think that he has a right. Mr. A has a right to sell at 110 for an asset whose current market price is as 95. Do you think Mr. A will be happy? Yes, he would be happy. Why? He would say that in open market, people are selling something at 95, but I have a right to sell it at 110. Don't you feel that he will be happy saying that this right is of some use to me? Hence, Mr. A will see this option as in the money option because this is helping him to the extent of 15 rupees compared to what outsiders will get if they sell it now, because outsider will get 95 rupees on their sale. Mr. A, because of this option or because of this put option, he will get 110 rupees. Correct? So this is in the money option and Mr. A will exercise the option. Now, while he will exercise the option, again, just to understand, we can understand that there can be two ways of settlement. One is gross settlement. What is going to be the gross settlement? Now, Mr. A will say to Miss B, okay, I have to sell this asset to you. I will give you the asset. Transfer shares. Receive 110 rupees. Simple. This is the gross settlement. Or in case they decide to do it with the net settlement. In that case, Mr. A will say to Ms. B, okay, let's not go into the transferring of shares. You give me 15 rupees, which is the difference of 110 and 95. And I will receive 95 from the open market after selling the share. In totality, I am getting 110 rupees. So that means 15 rupees is the net gain to me. So he will say that, okay, let me receive 15 rupees from Miss B. One more point, students, that to be noticed here is in practical life, in all the stock exchanges, currently the settlement will happen basis the net settlement, not basis the gross settlement. Correct? Because the derivative, which is the F&O segment, futures and option segments, all of that, the settlement will happen basis the net settlement. But still, I'm taking both gross and net just to make your understanding very clear. In case we have to go through the gross settlement also, the result becomes same. Now, what is the net gain or loss? Net gain slash loss will be calculated as premium is what amount? Premium paid was 10 rupees. He is receiving 15 rupees. So there is a 5 rupees gain here. Okay. There is a 5 rupees gain here. And to Miss B. Miss B have received a premium of 10 rupees, but she is paying 15 rupees. That means there is a loss of 5 rupees. Simple. Now let us take the next part of 110. This is what we have said that there for Miss B there is a loss. Now for 110, what will Mr. A think? Mr. A will say, okay, I have a right to sell something at 110 for which the open market price is also 110. So I am neutral. It is at the money for me. At the money for me. Neutral to exercise the option. Nothing will happen on gross or net because even if he exercises, there is no payoff on settlement. Correct? The net gain or loss will be how much here? Minus 10 rupees, which is the premium cost, sunk cost. Correct? Here, there will be a 10 rupees gain. So for Miss B, always the gain will be restricted to 10 rupees, which is the premium maximum. Maximum she can earn 10 rupees. That's all. Now, for this 125 rupees, if in the open market, the price is 125 rupees, what would Mr. A think now? Mr. A has a right to sell an asset at 110, but in the open market, he can easily go and sell it at 125. Is this a right anymore for Mr. A? No, this is not a right anymore. Why? Because this is not giving him some favorable benefit. This is not a right. So Mr. A will say, no, no, this is not a right. He will not be happy. Mr. A will say, not a right anymore. This is out of the money. This deal is out of the money. We say na, that this deal is very in the money, at the money, out of the money, that nothing can be taken it out from here. So this is a very out of the money deal. And hence, no settlement will happen in this deal. The net gain or loss will be still this 10 rupees of premium that he has paid is the loss. And here the gain for Miss B will still be the 10 rupees of premium that she had gained. Simple. Okay. So applying the same logic, we are able to now conclude one thing. Now I'm just putting two conclusions which we have to remember because this is all for the purpose of our calculating the logics and other things. Sorry. Okay, so now what does this says is in terms of conclusion for call option. I'm talking from holder's perspective, correct? The person who has held it. For call option, from the holder perspective, if it is better if price goes up beyond the strike price. If the price is going beyond the strike price and it is going up, then for the call option holder, it is better. That we have seen here. Correct? Sorry, this is the call option. In case of call option, 125 is fetching him the highest benefit. Correct? In case of a put option, better if price goes down below the strike price. If the price goes below the strike price, then for put option it is better. In other words, call option is giving you a benefit if the price is increasing, and put option is giving you a benefit if the price is reducing. Very easy, very simple from the holder's perspective. If you have to hedge against the prices going up, better to take call option. If you have to hedge against the prices going down, better to take the put option. Okay, we will cover those techniques also in detail, but this is what the bottom line is. I hope the settlement and everything is very clear. Now let us try to see the difference between option and futures, both of them. So we will see the similarities as well as we will see the differences. Okay. First of all, we have an underlying asset here. We have an underlying asset here also. Correct. The So basically, the second point of similarity is the time limit. Correct. We have a fixed time limit here, and we also have a fixed time limit here. Now, what are the non-similarities? Non-similarities or the causes of differences for options. It gives you a right. It is not a mandate. It gives you a right. But futures is a mandate. So in our previous example, if we were talking about in case of call option, let me take it. If instead of call option, if we would have the normal future purchased at 110, assume strike price is the future price, which is 110. And on expiry, it would have been 95. Then for a future buyer, let's say I have purchased a future, that 15 rupees would have been a cost. That 15 rupees would have been a loss. But whether that 15 rupees is coming here as a loss, no. Only that 10 rupees is coming as a loss, which is paid as a premium. You're getting a point. So here it is a right and here it is mandate. Here for the holder, unlimited gain. Or I can say only gain, no loss. Let me say it like this. Only gain, and gain is subject to premium. That's all. Because you have to pay a small amount of premium and then you are entitled for a entire gamut of gain subject to premium. Correct? But here it can be gain or loss. There are chances that he can incur loss also. Correct? Because futures, it is a mandate. You don't have any option. If you purchase a future, you will have to settle the future basis that rate. Okay, students. So this is the basic difference between an option and futures. Now, both of them are also standard contracts. For example, the strike price, the lot size, here also the future price, the lot size will all be under a standard terminology dealing on a stock exchange. These are standard contracts. Although future price will keep on changing, but here in case of future price, premium will keep on changing. Premium will go up or down. Correct? Basis the demand and supply of an option, because the price of an option is premium. Correct? The price of an option is premium. Hence, the premium price will go up and down in the stock exchange. Correct? And in case of future, the future price will go up and down. Okay, these are some of the basic differences between both of them. Now, let us try to see the 4 different types of payoffs from both the angles. Now, let us see the payoff. This we are talking about, first of all, call option buyer perspective or holder perspective, or we can also say that the person who has done the long call. Long call means, remember from forwards and futures, we say long means purchase, short means sell. So long means the person who has done the long call. That means who has purchased the long, who has purchased the call option basically. So if I plot on a 2D axis, here is the price of the underlying, correct? and here is the payoff. Okay, so there is 0, let's say 5, 10, 15. Here we have -5. Here we have 10, 20, 30, 40, 50, let's say 60, correct? And in all our examples for this payoffs, we will say that strike price is as 40 and premium is as 5. Now imagine for a buyer or a holder of a call option, the premium cost will be sunk cost till the time the spot price reaches 45. How? 45? 40 is the strike price plus 5 he has to recover the premium also, correct? So basically at 45 he will be at no gain, no loss. Zero gain, zero loss, considering the premium cost also, correct? So $45 is somewhere here. So you see, in case of call option, if the price increases beyond 45, the gain to the call option holder will also increase. So can I mention this benefit to call buyer if price at expiration crosses beyond 45, correct? If it crosses beyond 45, 45 is somewhere here, right? This is 45. Then he will start getting the gain after reducing the premium, because 40 rupees is the strike price and 5 rupees is the premium. Very simple, very easy. But if you see, the loss is restricted here. The loss is restricted only to 5 rupees. It will not go beyond that. Okay. Now let us see the second case here, which is the call seller. Now we will take it from the call seller point of view. Call seller, or we can say the person who is doing the short call. Correct. Again, the strike price is 40 and premium is 5. Okay, so Harshad is asking, holder will gain when price goes up, then strike price, yes, and below in case of put, otherwise is also lose premium. Yes, yes, Harshad, that's right. So in case of a call option, the holder will gain in case the price goes beyond strike price up. And in case of put option, if the price goes down from the strike price, correct, then the option holder will gain. Okay. So we have a strike price of 40 here, premium of 5 here. And we are talking about from the perspective of call seller, not from the call buyer. So this is what the writer is. Okay. Now, if you see, as I told you that the writer's gain is limited to what? Let's say this is 0, 5, 10, 15, -5, -10, -15. For a writer, the negative line will go down, correct? Because the loss is unlimited. Net payoff, and this is the price, 10, 20, 30, 40, 50, 60, and like that. Correct? So what will happen up till 45? Up till 45, the call writer will have a gain limited to 5 rupees. After 40, the gain will go down, and at 45, he will come to the break even. Below 45, so basically, if the price goes more than 45, then call seller writer will lose because he's losing here, correct? So there is a loss to call seller in case the price goes beyond and above the strike price. I hope this is clear. This is from the call writer perspective for call option. We are left with two more cases that we will cover now, and then we will go to the questions. Okay, students. Now, coming to the next part. Now, let us talk about put option. Now, what does this put option says? It's a right to sell. Put option is right to sell. We are talking about the first from the perspective of holder of the right to sell. Okay. We can also say long put. He is doing the long put. Here have we put short call? Yes, yes, yes. So long put or holder or put buyer, whatever we can say. Again, the strike price is 40 and the premium is 5 rupees. Now, if we put with this information a graph here, this is the price again 10, 20, 30, 40, 50, 60. This is the price, correct? And 5, 10, 15, 20 minus 5 minus 10, like this. Then what is going to happen is, now the holder will gain in case the price goes down. Price goes below 45, correct? Till 45. Let's say from 60 till 45, he will lose. So he will lose how much? 5 rupees only, because 5 rupees is the premium. Then slowly he will start gaining. And then the final ultimate gain will come to him once the price further goes down from 45, correct? Because here the price is going down, correct? Here the price is going down and hence benefit to the put buyer would accrue in case the price goes down below 45 rupees. Then only put buyer will gain, correct? That's what we have also seen in the previous examples in the previous case studies. So the graph will look like this. So simply speaking, the graph will be looking like this. Okay, because the ultimate gain is there and loss is restricted to this line. Let's note down. This is our third case where the put option, we are talking about the holder. Now the last case, put option, let us talk about the seller. Okay, put option. In case of a seller, we can also say short put. Who is doing the short put? Strike price again of 40 rupees. Premium of 5 rupees. Now, from the perspective of the seller, the price or the gain is limited. The loss is unlimited, correct? So the graph will look like something. Now, again, I'm making the negative side a bit more. -5, -10, -15. 5, 10, 15. This is again the net payoff. 10, 20, 30, 40, 50, 60. This is the price. Now 45 is the price. Correct? 40 plus 5 of premium. If it goes beyond 45, below 45, sorry, wait, one catch that I missed here is, actually, if you see, okay, let me go to the payoffs of put option again. Okay. See, in case of call option, the person will say 40 plus 5, 40 rupees of strike price and 5 rupees of premium. Okay. But in case of put option, see, let us take one more example here. Okay, let us take one more example here. In case it is at 100 rupees, correct? Then in this case, what will happen? Mr. A will get plus 10 and minus 10 of premium he has paid. Plus 10 he will get from the Miss B, correct? Mr. A will get from Miss B because 10 rupees is still, the option is in the money. So hence the nil amount will come at 100 rupees of spot price, correct? So we have to change our graph only for this put option. It's good that we noted this. So instead of 45, it should be 35. The line should cross at 35. I hope all of you are getting the point. Because at 35 also, he will make no profit, no loss. Correct? So instead of 45, we should mention here as 35. Okay? Please correct. All the students, please correct. There is some miss that has happened. Instead of 45 for put, it should be 35. In case the price goes below 35, then he will gain. In case the price is between 35 to 40, equivalent to the premium he lose. In case it is less than 40, then only he will gain in some real sense. Okay. So here also, instead of this 40, Let me take 35 here, correct? Now, the net payoff for a put option seller is limited to this 5 rupees as a gain, and as a loss is unlimited. The price will keep on going down. He will continue to incur the losses. Okay. He will continue to incur the losses. So loss would be higher in case the price keeps on going down. Simple. In case the price keeps on going down, below 35 it goes, he will start incurring the loss. Miss D will start incurring the loss. Okay, Namita is asking, sir, in real life, writer of option will use some projections to calculate price in future. So generally there is no loss to them. Am I right? That's right, Namita. We will also cover that in the valuation principles now after just this, how to really value the options. In that, the writer of the option is also very smart. So he will not say that at any strike price we will just make the option and do the transactions. He will also do some set of calculations at his end, and then only finally he will propose what is the requirement in the strike price. Correct? So he will definitely do, and he will also take into account that what kind of strike price will benefit him, so that he is gaining on the premium. Because I'll tell you, Namita, in some cases the people only write this option to earn premium income, because they know that going forward this cannot be exercised. You're getting the point? This cannot be exercised. Hence they will just try to earn the premium and they will write the option, because in future, in the time to come, they are not going to pay any payoffs to the holder. Okay, Namita? Good. So Jitendra is asking, premium paid is sunk cost. Can premium is up and down their volatility of underlying assets? How traded are done stock exchange regarding option? Okay, Jitendra. So this is something that happens practically. Since you are asking, let me put here. So for example, on a share market, okay, this is a stock exchange. If we talk about an equity share, okay, stock exchange, we talk about an equity share. So equity share, there is a buyer and there is a seller, and the price has to be matched so that the deal goes through for buyer and seller. Correct? Now this price is what? The value of a equity share, the price of a equity share. That is the price. Now, in case of a future, again, I am talking about stock exchange. There is a buyer and seller of this future. He's the buyer and he's the seller. So for future, also there has to be a price, which is we call as future price. This we call as spot price. Correct? This we call as spot price. This we call as future price. So the buyer will buy at future price and seller will sell at future price. Correct? So the deal to be done through between both of them, future price is there. Now, in case of options, this is the stock exchange. We're talking about options. Can the trading happen basis the strike price? No, because strike price is fixed. Strike price is part of the terms and conditions mentioned in the option contract. What is variable? Variable is only premium. Now what will happen? Buyer and seller will strike a deal if the premium matches. If the premium matches for buyer and seller, they will strike a deal. And today, let's say today, the buyer purchased a call option at a premium of 10. Tomorrow, he sees that, okay, now the same option, call option is being traded at 12 rupees. He can sell that option tomorrow and make 2 rupees of income. Okay. But don't get confused. This is not what required to study, but I'm just telling you from the practical life since Jitendra asked it, correct? So the trading happens basis the premium price because premium is the price of an option. Similarly, future price is the price of the future. Spot price is the price of the equity share. Okay. This is what the difference is. And people can play in premium as well, is what I have put here. Whatever is the difference between premium on two dates, they can purchase and sell it and they can square up the position. Okay, students? Okay, now let us go to the question number 15. Very easy and very simple question. This will help us in revising the concepts that we have done till now. So it says that equity share of PQR Limited is presently quoted at 320. This is the spot market rate. Okay. The market price of the share after 6 months have the following probability distribution. So they are saying after 6 months, there are different probabilities for the prices to happen at a different level. And these are the probabilities. A put option. Please note, we are talking about put option. Put option is right to sell. Okay. With a strike price of 300 can be written. Can be written means from the point of view of seller, he's saying that 300 strike price put option can be written. You are required to find out expected value of option at maturity, that is 6 months. So they are saying at maturity, what would be the expected value of an option? Very easy, very simple. Since it is a put option with a strike price of 300, since it is a put option with a strike price of 300, the benefit, the value of an option, what we said is it will be, see, this is, if this is the price, okay, let's say 400, 450, sorry, 400, 350, 300, 250, 200, correct? Let's say this is the price up to 300 and above. It is out of the money, correct? Because this is a put option. Put option will become in the money once it is going below 300, then only it will be in the money, correct? And at this line, it will be at the money. At this line, basically, okay? This is what I just wanted to explain you. Now, Namita is asking, sir, are these standard contracts? How in options, how premium can go up or down? Yes, Namita, these are all standard contracts, but premium is not fixed. Premium is variable. That's why it is called as derivative. Premium will derive its value from the spot price and the strike price combination that we will study in the later session to see how the valuation works for an option. Okay. So these are standard contracts. Strike price is fixed. Underlying is fixed. Underlying asset is fixed. Expiration is fixed. The only thing that is not fixed is the premium. That will depend on the market forces. Now, we can say that expected value of put. How we can calculate this? If you see what is the strike price, 300. Market price in case of, okay, let me put the probability distribution here. Probability, we can put here like this, 0.1, 0.2, 0.50, 0.10, and 0.10. Is this 100? 3, 2, 5, 10, yeah, 100. All is 100. That means 1. Okay. Market price This is the market price on expiry. Okay. 180, 260, 280, 320, and 400. These are the different market prices. Now, the value of put option value, we are just putting like this. Now you tell me, if the market price after 6 months is 180, there is a put option of 300. Would there be a benefit? Would this be called as in the money? Yes, it would be called as in the money because the price is lesser than 300, as we have studied above. Correct. So this is 300 minus 180 is equal to 120 will be the in the money option value. In first case, correct? In first case. Now, second case, 300 minus 260, 40 rupees will be the benefit. 300 minus 280, 20 rupees will be the benefit. 300 minus 320. Now, you see here, there is a right to sell at 300 for a asset which is openly getting traded in the market at 320. So, is this a right anymore? No, this is not a right anymore because you can easily go in the open market and sell it at 320. Why will you exercise the right to sell it at 300? Okay, so this is not a right anymore. Similarly, 400 is also not a right anymore. So now let us calculate the probability multiplied by put option value. Correct? Because this 120 is not the 100% of the case. It is only 10% chance that 180 would be the price. So 120 multiplied by 10% is equal to 12 rupees. 40 multiplied by 20% is equal to 8 rupees. 20 multiplied by 50% is equal to 10 rupees. Nil, nil, and total will be 2030. So the expected value of put is equal to 30 rupees after expiry, on expiry basically. This is on expiry. I hope this is very clear to all of you. Very easy, very simple. Just calculated the payoffs. Even we don't know what is the premium in the question. We are just required to calculate what is the payoffs in case of a put option at different levels of probabilities. Namita is asking, sir, in case of put buyer, 45 is not neutral point. It is at 35. Yes, Namita. That's what we corrected also. Wait, let you all note it down and then I will go to the other point. So Namita, you are right. We corrected that option. We corrected that mistake actually. In case of a put buyer, the neutral point will be 35. It's not at 45. That we corrected in both the graphs. If you see here also it's 35. And here also it is at 35. The reason also I told you, what is the reason here? Is that still the premium will, because the price has to go down, then the premium also has to be recovered. That means the price has to go further down below premium, minus premium from the strike price. Okay. Now there are some questions. Harshad is asking, expected value means premium. You're right, Harshad. Basically, that is what the premium from the point of view of writer would be. Correct. But for that, we have to take a present value of it. Because if you see this expected value of 30 rupees is after 6 months, correct? So we have to take a present value to do the premium calculation. So Harshad, you're right. Jitendra is asking, long call is equal to put writer. Okay, Jitendra. Long call is equal to put writer. Actually, we will comment upon this in the next session. Okay, Jitendra. So it might be right, it might be wrong, but we will try to see it in the next session, because next session is going to be around this only. Okay. But although if you say long call means purchasing the right to buy, and put writer means selling the right to sell. Selling the right to sell means he will purchase the share, and long call also will mean he will purchase the share. So from that angle, it is okay. So let me explain it here. Long call, put writer. Long call, who is doing is purchasing a right to buy. Ultimately, he is going to purchase the underlying, correct? The effect of this is he is going to purchase the underlying, correct? Put writer is selling the right to sell. Selling the right to sell. Once he does that, basically he is purchasing the right to buy. Put writer is selling the right to sell. Selling the right to sell means he will purchase the share, purchase the underlying after expiry, correct? So he will also do the purchase the underlying. So elementary wise, both the things are same, because effect will be given on purchasing the underlying only in both the cases. Okay, Jitendra. So this is what is right in terms of the transactions thing, correct? But still, the payoffs has to be seen to comment whether the payoffs is also equal or not. Okay. Yes, Harshad. Harshad is asking, long call means holder. That's right. Long call means purchasing the call, and purchasing the call is done by holder. Similarly, long put means he's the holder of the put option. Okay. Long call means he's the holder of the call option. Long put means he's holder of the put option. Okay. Yes. Now let us go to the next concept. So, Harshad, as you said that expected value means premium, I will take it from there only. Okay. Because my next concept starts from there only. So I'm saying without any formulas, without anything, what is logically what is the value? Can we say that? Logically, what is the value of option? See, the writer or the seller of the option. Okay. Wait, there is some confusion related to the previous question. Just a second. So Namita is asking, in previous question, we are not taking the present value. So why you said that we need to calculate the present value? Namita, that present value I was replying to Harshad's query actually, because Harshad has asked that is 30 rupees equal to the premium. I told that yes, 30 rupees is equal to the premium, but 30 rupees is the future value. We have to take the present value of 30 rupees. That will be the premium. There is no requirement in the question to calculate the present value. I was only replying to the query. Okay, Namita? So don't get confused. So the question is still here only, this 30 rupees. Okay. Now, what I was saying here is, now all of you please concentrate here. Logically, what do you see is, what is the value of an option? See, if we talk about value of call option, think it from as if you are the writer, you are the option writer. Now you are an option writer of call option. What do you think? You can maximum, what is the bare minimum premium that you would expect? The bare minimum premium that you would expect is, you would do a expected market price in future that you will do basis the probability distribution, and you will say what is the spot price. Whatever is the difference between both of them, that is the maximum loss that you have to incur, correct? as a net payoff because we are the option writer. Hence, that is the minimum premium that I would expect. I hope I'm clear. Okay, let me write here expected price minus strike price. Very easy, very simple. This is what we have already done in the previous question. There was a value of put, correct? In that, the put option was there, but value of call, expected price minus strike price. Now, for example, expected price is 120, strike price is 110, correct? That means 10 rupees will become the value of call option, which is nothing but the premium. But this 10 rupees has to be done a present value. We cannot take 10 rupees as it is. We have to do the present value and take it. Now, value of put will be, it will be reversed now. Strike price minus expected price. Because put will give us a benefit once the price goes down. The strike price, correct? The strike price minus expected price. Now let's say strike price is 110, continuing the same example, and if expected price comes out to be 90, so the minimum premium that a writer will expect on this kind of a put option will be 20 rupees present value, correct? Because 20 rupees has to be paid in future. So present value of that will be expected as a premium. This is what logically the value will be, correct? Let us go to the question number 16. So question number 16, what does it say? You as an investor, had purchased a 4-month call option. First of all, we are saying that it's a 4-month call option on the equity shares of X Limited of rupees 10, of which the current market price is 132. The current market price is how much? 132. Exercise price is 150. Exercise price is equal to the strike price. Sometimes the term is used as exercise price, sometimes the term is used as strike price, correct? So don't get confused. Spot price is 132, exercise price is 150, face value is 10, and 4-month call option is what we are talking about. You expect the price to be in the range of 120 to 190, which is given in the following table: 120, 140, 160, 180, and 190. The expected share price of X Limited and related probability distribution is given as follows. This is very simple probability distribution. Compute the following: expected share price at the end of 4 months. See, first part of the question is nothing, is very easy because we have to calculate the expected share price. See, wherever we use the word expected share price, expected value of premium, first of all, we have to do the calculation and then we have to multiply with the probability. Simple. Because multiplying with the probability, you will get the expected price. First part. Calculation of expected share price. Now, what is this? Expected share price. We are given, let's copy the table. 120, 140, 160, 180, and 190. Okay. Probability is also given: 0.05, 0.20, 0.50, 0.10, and 0.15. This is the probability. Simply expected price will be price multiplied by probability. So 120 into 5% is equal to 6. 140 into 20% is equal to 28. 160 into 50%, 80. 180 into 10%, 18. 190 into 15%, 28.5. So the total is 160.50. Okay, students. So the expected share price is calculated at the end of 4 months. So the expected share price will look like as 160. Okay, first part is done. Value of call option at the end of 4 months. Okay, so he's not asking you to do the present value. The question is only asking you to calculate the value of the option at the end of the 4 months if the exercise price prevails. What does this line means? They are saying that if the exercise price prevails, that means exercise price is equal to spot price on expiry. This is what they are trying to say. Correct? If the exercise price prevails, what is the value of call option? Simple. It is at the money option. Correct? So we can say that value of call option if exercise price prevails. So 150, what we have studied just before, value of call option, how it is calculated. Now, the question is asking on expiry, not the present value, correct? So it will be expected price minus strike price, correct? What is the expected price? Expected price is 150. Minus 150 strike price. This is the value of call option. Hence, it is equal to 0. This is at the money. Okay. The value of call option, if exercise price prevails, is 0 because it is at the money. Third part. In case the option is held to its maturity. Okay. What will be the expected value of the call option? So now students, they are asking that in case it is held to maturity, what would be the expected value of the call option? Again, they're asking at the time of expiry only. This they are saying on expiry, what is the value of the call option? Simple. So in this, what we are going to do is we are going to adopt the last question practice. So there are two ways. Okay, now there will be two school of thoughts that will come to all of you. One is that we can just simply take 160.50 as expected price and 150 as strike price, and whatever is the difference will be the expected value of the option. No, that is not right. Because while doing that, you are taking an inherent assumption that in case of 120, 140, 160, sorry, up to below 150 basically, 120 and 140 also you will make some money on the option, which is not right. You will make zero money on 120 and 140. Had this question be on forwards and futures, we could have used this 160 right away. But this is a question on options, hence we cannot take this 160 rupees and do the calculation. What we have to do is expected value of call option on maturity. Okay. First of all, what is the price? 120, 140, 160, 180, 190. Now, value of call option. How this value of call option is determined? Simply the expected price minus the strike price. Strike price is 150. In this case, 120 minus 150, 0. 140 minus 150, 0. Now, please understand the holder of the call option, how he will analyze it. He will say that I have a option to purchase, what is this underlying? Equity share of X Limited, correct. I have an option to purchase an equity share of X Limited at 150 rupees. However, in the open market, I am getting it 140 rupees. Is this a right anymore? Is this an option anymore? No, this is not a right. This is just a sunk cost for me, whatever premium I have paid, and hence the value of call will become zero. But in this case, he will say that in open market, I can get at 160, but actually I'm getting at 150. So there is a 10 rupees benefit. Here, similarly, here it's the 30 rupees, here it's 40 rupees. So it is 190 minus 150. Is the respective value of call. Then what is the probability? 0.05, 0.20, 0.50, 0.10, and 0.15. This is what the expected value of call. To calculate that, we have taken the probability value of call, and hence the value of call will be 0 multiplied by 0.05, 0 multiplied by 0.20, 10 multiplied by 0.50, correct? Because 10 is the value of call for which there is a 50% chance. Okay. So that comes out to 5 rupees. 30 rupees is the value for which there is a 10% chance. So there comes as 3 rupees. 40 rupees will be the gain for which there is a 15% chance. So there will be a 6 rupees here. In totality, 6, 3, 9, 5, 14. 14 rupees is the value of call on expiry. On maturity is 14 rupees. However, if you would have used the 160, expected this 160.5 minus 150, it would have been 10.5, which is completely wrong. I'm putting a cross here so that you guys know that this is completely wrong. Because in this case, in the above case, we are making an assumption that there is a loss on expected price. There is a loss when expected price is lesser than strike price. If we are doing this, then we are saying that instead of 0 here we have to put it as minus 30. Here we have to put it as minus 10, which is not the case, right? There is no loss. Because this is an option, there is no loss. Correct? Hence, we cannot adopt this route. This is completely banned for us to adopt. We have to take the individual values for the individual cases, then multiply with the respective probabilities. I hope I am able to clear the question. Now let me take the query. Sir, in third part, we are holding option till maturity. That's right. In third part, we are holding the option till maturity. That is why on maturity, we are given these different prices also, correct? With the probabilities. And hence, we have taken the respective values on maturity. Namita is asking, sir, in question 2, what will happen in spot market after 6 months? It's related to previous class. Okay, let me go to the question number 2. I hope you're referring to the question number 2 basis the sequence given in the assignment. This one. So your query is, what will happen in spot market after 6 months? So spot market, nothing will happen. Whatever will be the price in the spot market, that will prevail simply. Okay, so in second part, Namita, are you asking? The arbitrage here will be calculated whatever we have purchased in spot price, this of worth of 1800, we will sell it simply, and it will be sold at the spot price rate, correct? So if here we have explained, okay, let me take the query. In this, we have devised one arbitrage strategy in which we said that we will purchase the share and we will sell the future at 1950. Purchasing the share at 1800 and selling the future at 1950. Now, that means to purchase the share, initially we will have to take loan, amount will go, the initial cash flows will be nil. Ultimately, our holding will increase by one share. That is the initial cash flow. After 6 months, we will sell and realize at 1950. Because whatever is the spot market, let's say spot market ends at 1900, or let's say it ends at 2000, you will still be able to realize 1950 itself because of this arbitrage strategy. Because here in this arbitrage strategy, you are saying that I am entering into a contract to sell at 1950. Okay. So you take a case where even the spot price is 1900, still you will get 1950 as the total realization. Shall I tell you how? Okay, if you take 1900, the gain on futures will be how much? Let us take 1900, correct? Gain on futures will be 50 rupees, correct? Sale in spot market will be 1900, correct? How much you get? 1950. Similarly, if the price is 2000 in spot market, then in this case, you will have a loss of 50 rupees. 1950 minus 2000, and you will sell at 2000 rupees in the spot market. So loss of 50, sale of 2000, again you will have a 1950. In whichever case you see, you will get 1950 only. Hence, we have taken here as 1950. Okay. So the spot market also will happen accordingly. Okay, Namita, I hope I am able to answer your query. So Jitendra is saying all things dependent on demand. Definitely yes, Jitendra. Everything is dependent on the demand and supply. The prices are actually dependent on demand and supply. Question number 15th is done, 16th is done. Yes. Now let's go to the question number 17. Again, a very good question. Now please pay attention. Question number 17. Mr. X established the following strategy on Delta Corporation's stock. Now see the kind of strategy that Mr. X is adopting. The underlying is what? Delta Corporation's stock. Okay, Namita, thank you. Mr. X established the following strategy. What is the strategy? Purchased one 3-month call option. Yes, purchased one 3-month call option with a premium of rupees 30 and an exercise price of rupees 550. Also, he purchased one 3-month put option with a premium of rupees 5 and an exercise price of rupees 450. Okay. In both the case, he has been holding the right. One way he is holding the right to buy. Second way is holding the right to sell. Then Delta Corporation stock is currently selling as 500. Currently, the spot price is 500. Determine profit or loss. If the price of Delta Corporations remains 300 after, sorry, 500 after 3 months. Okay, now let us first tabulate this information. 3 months, call option. Premium, how much he has paid? 30 rupees. 3 months, put option. Premium, how much he has paid on the put options? 5 rupees. What is the exercise price or the strike price? 550, 450. Correct? This is the exercise price. Also, we are given that, assume that the size option is 100 shares of this. So this is a lot size that they have given. So the minimum trading will happen on 100 shares equivalent. So we can put lot size here. 100, 100. Now for calculating the profit or loss, let us first calculate the sunk cost, correct? The sunk cost means the total cost on premium that he has paid, because that is definitely a cost. If, whether we have profit or not, that will come as a cost, correct? Premium paid will be how much? 30 multiplied by 100. On 100, it will be paid. Minimum lot size is 100. 3000. 5 multiplied by 100, 500. Total 3500 is what the premium is. So initially, he will pay a premium of how much? Initial payment of premium is 3500. Okay. Now, let's go to the first part. I have calculated this because this is common to all the parts. Whatever the subsequent cash flows are there, initially the payment of premium has to happen at 3500. Okay. Now, if the price is at 500, okay, at maturity, the price is equal to 500 rupees. Now, tell me, call option. Is it in the money, out of the money, at the money? Exercise price was how much? 550. This will become out of the money because the price has gone below the strike price. 500 has gone down below 550. So this will not be exercised, not exercised. Put option. Strike price is how much? 450. Maturity price is 500. The spot price on maturity is 500. This is also out of the money because if it is lesser than 450, then only some benefit would have come. This is also out of the money. Not exercised. This one is also not exercised. So that means in the first part, net loss is equal to rupees 3500, which is the premium that we have paid because there is no income, there is no subsequent income that has happened here. Everything, whatever we have paid as a premium has gone for a loss. This is done by Mr. X. Because he has taken a call option at a strike price of 550, anything below this will not give him any benefit. Put option 450, anything above 450 will not give him any benefit. Hence, net he is not able to earn anything on the both the options. Out of the money, right? Both of them are out of the money, Namita. Yeah, you're right. So Namita is asking, sir, in third part of question 16, why solution is different from second part. Requirement of both are same as to hold till maturity. Okay, Namita. See, in this question number 16, if you see, the second part says if the exercise price prevails. This is the only change in second and third part. Third part is saying that it is held to maturity. You apply this table and calculate the answer. Simple. But second part is saying you that if the exercise price prevails, then what is the value of call option? If exercise price prevails means expected price is also 150 and strike price is also 150. Very easy, very simple. Okay, Namita. That's why there is a change. Because if this line would have not been there, exercise price prevails, then second and third would be the same answer. Okay. First part done here. Now, second part it is saying is falls at rupees 350 after 3 months. Now, the second part is saying that what if the price falls at 350 after 3 months? $350 at maturity. Now for call option, who is having a which is at an exercise price of how much? 550. The price is 350. Exercise price is 550. The option holder, Mr. X, will say, I have a right to purchase 550 of Delta Corporation, which is easily available outside the market at 350. Is it a right to me anymore? No. Mr. X will not be happy because it is not a right. Although there is a no loss to him, but there is no right also to him. Correct. So this is out of the money. And we will say that this is not exercised. Put option, exercise price of 450. 350 is the price. 450 is the exercise price. Now see what Mr. X will say. Suddenly he will be very happy now. Why? Because he will say, in the market, I can sell Delta Corporation stock at 350, but under this contract of options, I'm holding a right to sell it at 450. Don't you think this right is actually a right for me? Yes. And what is the benefit under this right? 450 minus 350. Correct? So this is in the money. Please remember we are talking about put option. Okay, don't get confused. So this is 450 minus 350 multiplied by what is the lot size? 100 units. So 10,000 will be the income here minus premium paid. Premium paid how much? 3,500. Net profit to him is 6,500. Net gain is equal to 6,500. Why there is a net gain of 6,500? Because 10,000 he has been able to get from put option, but he has already paid a premium of 3,500. So there is a net gain of 6,500. Now comes the third part. Rises to 600. Now they are saying that the price rises to 600. At maturity, it is 600. Then call option having an exercise price of 550. Don't you think Mr. A will be happy? Mr. X will be happy? Yes. He would be happy because 600 is something he can get out of the in the outside market, but under this option, he's able to get the same thing at 550. So yes, this is in the money. 600 minus 550 into 100, around 5,000 rupees is the gain to him. Put option. So put option having a exercise price of 450, the price is 600. He can go out easily sell in the market at 600. He don't need to exercise the option. So this is out of the money. Not exercised minus premium paid of 3,500. Net amount is 1,500. Net gain. Namita, third call in the money, put out of the money. Very good, Namita. That's right. Perfect. Sir, so we can say that in this question, writer writes option to earn premium income as both are. Yes, Namita, that's right. Perfect. In both the cases, it's out of the money, and hence the writer is writing to earn the premium. And the holder is just is because see, ultimately, if on stock exchange, someone thinks that I have purchased at a very low price, then there is a other party also who thinks that I have sold at a very good price. Correct. So it's all about the perspective between holder and writer. Okay, what I'm trying to say is, let's say there is some kind of a rumor in a stock market. Okay, you first note this point, then I will elaborate what I'm trying to say. See, what I'm saying is, in stock exchange, okay, the buyer purchases at, let's say, 100 and seller also sells at 100. Now buyer also thinks that I have done a very good deal. I have purchased at 100 because I think the price will go up in future. On the other hand, seller also thinks I have also done a very good deal because 100 is the maximum price that this share price can go. Beyond this, there is no chance it can go. So both of them think that they are smart, but actually one of them will fail in their assumption. Correct? If the price moves up, seller will fail in their assumption. If the price goes down, buyer will fail in their assumption. Similarly, Namita, as you have mentioned, so option to earn the premium, option writer will write it. That is what the expectation is, but actual outcome can be different. Even this is applicable for both holder as well as the writer. Okay. Okay, now we have to understand the concept of binomial model. Now let us go to the actual valuation. Let's start the valuation principles on options. So in our curriculum, there are three valuation techniques. Two of them we are going to cover now, and both of them are related only actually, which is the binomial model and risk neutral model. And one Black-Scholes-Merton model is what we are going to cover in our next session, because for that we have to understand the basic concepts first, which that is premised. Okay, so let us start with the valuation techniques. So the first valuation model that we are going to study is binomial model. Okay. Now, what does this binomial model says? Okay, what does this bio means? Bio means two, either 1 or 2. 1 or 2. 2. That is what bio is. Or I can say either upper or either lower price. Upper price or lower price. Correct? Either the price will go up or the price will go down. Simple. Bio means either or two. Okay, Namita is asking, sir, will option writer face losses when COVID impacts stock market? Now, this is a very difficult question. I cannot comment upon this question, Namita, because a lot of things will depend. We cannot say that someone will face loss or someone will face gain. Um, Due to COVID, there can be some industries which where will be gain. There can be some industries there will be losses. So it would be difficult to generic solution on your question. Okay, Namita. So the binomial model, as I was saying, that it will say that it is a two-step model which will always assume either your price will go up or your price will go down. Either your price will go up or your price will go down. For example, let's say this is the 0 day, which is today. Okay. From here, after 3 months, again, I'm taking time expiry as 3 months. After 3 months, either the price can go up 10%. Let's say today the price is 30 rupees. It can either go to 33 rupees or it can come down to 27 rupees. Minus 10%, plus 10%. Okay. Now, again, I'm also saying that what is the strike price? Because now we have to relate it to our options. What is the strike price that we are assuming here is, let's assume a strike price of 28. So we are saying there is a strike price of 28, time to expire of 3 months. Today's spot rate is 30. Now, what does binomial model says? How to value this? How can we value this? First of all, we have to assume that there are only two possibilities. One is that the price will go up by 10%, and second, the price will go down by 10%. Correct? 33 and 27. We have to calculate the payoffs here. How will be the payoffs calculated? So if the price is 33 and we are talking about call option here, okay, we are talking about call option, price is 33, then how are we going to calculate the payoff? Simple. 33 minus 28. 5 rupees is the payoff, correct? Because in case of a call option, if price is going up, okay, my mistake, it's binomial. Okay, spelling mistake. Please correct it. Thanks, Arshad, for correcting it. Okay. Now, what does this says is, if this is a 5 rupees, okay, we are getting a right to buy at 28 rupees. The current market price is 33, hence the gain will be 5 rupees. The payoff will be 5 rupees. Okay. But in this case, 27 minus 28, would there be a loss? No. Ultimately, it will be 0. Correct? Because the loss will not be recovered from the option buyer. Hence, the payoffs are coming as 5 and 0. Okay. It is coming as 5 and 0. That is the first point. We have calculated, first of all, we have assumed that there are only two possibilities. Against both the possibilities, what are the different payoffs available? Now, the second step is to calculate the probabilities. What is the probability that it will go to 33 and what is the probability that it will go to 27? Correct? For that, there is a formula that is given to us. Now, there are two ways to calculate the probabilities. Two ways to calculate the probability. First way is what? First way, there is a formula. probability of price going up. Sorry. So here we will get the probability of price going up through this formula. Now, what are these notations? R is equal to actually the expected rate of interest. Correct? For the relevant time period. D is equal to, in our example, it will be 27 by 30. U is equal to 33 by 30. So D is the proportion of decrease. U is the proportion of increase. Simple. Proportion reduced. Proportion increased. Okay. Now, if we say that there is a 10%, there is a 10% per annum interest rate for 3 months, it will be how much? 2.5%, correct? 3 months rate is equal to 2.5%. So what we are going to do is, in this formula, we will calculate 1 plus 2.5% minus 27 by 30 divided by 33 by 30 minus 27 by 30. Simple. This will give us the probability of price moving up. If we solve this, we will get 62.5%. Correct? So the probability of price going up is 62.5%. Similarly, the probability, since there are only two options, the probability of price going down will be 100 minus 62.5, which is 37.5%. Correct? We have calculated the payoffs. We have calculated the probability. For calculating the probability, we have gone through this formula. Okay. Now, there is one more way to calculate. Second way to calculate the probability. Calculation of probability. This is called as risk neutral approach. Correct? Under this approach, how we can calculate is, we can equate this 30. 30 is what? The present value. This 30 is what? The present value. 33 is the value after 3 months, and 27 also is the value after 3 months. So let us assume, let the probability of price to be 33 be P. We are assuming, let the probability that the price after 3 months is 33 is P. That means 33 multiplied by P plus 27 multiplied by 1 minus P. I hope this equation you all are able to understand. Whole divided by 1 plus R percentage. This is what? The present value of future expected prices should equal to the spot price. Simple. Correct. In this case, what we are doing is, we are just calculating, first of all, the expected price. The expected price on 3 months is going to be 33 multiplied by the probability and 27 multiplied by the probability of 27, which is 1 minus P. Whole divided by, we are taking a present value and equating it to 30 rupees. Now, if we solve this, so 30 multiplied by 1 plus 2.5%. Actually, students, if you note, this formula is derived from this equation only. Okay, the formula is derived from this equation only. So you can use this equation as well as directly you can use this formula also. Okay. So 30 multiplied by 1 plus 2.5%. So I am taking this here basically, correct? Is equal to 33p plus 27 minus 27p, correct? So 30 into 1.25% comes as 30.75 minus 27 is equal to 6p. If we solve this, correct? And hence the p is equal to 3.75 divided by 6. Okay, which is equal to 62.5%. The same number that we have got basis the above formula, because this formula is also derived from that equation only. And for the 27 rupees, we can calculate the probability like this, which is 100 minus probability of price going up. So probability of 33 is equal to 62.5%. Probability of 27 is equal to 37.5%, which is 100 minus 62.5. Simple. And now how to calculate the value of this option? Very easy, very simple. Now what we're going to do is payoff multiplied by probability we are going to do here. So 5 into 62.5%. What is the value? If we do 5 into 62.5, percentage comes as 3.125. This will come as 0, correct? Because the payoff is 0. Probability can be anything. The ultimate will be 0. So the total is 3.125 after 3 months. So the value of option is equal to present value of probability adjusted payoffs. This we can do it like this: 3.125 divided by 1 plus 2.5%. This is the value of call option. Value of call option will be divided by 1 plus 2.5%, 3.125 divided by this comes as 3.048. 7. This is the value of call option as per binomial model. This is all binomial model. What does it say? I will repeat the steps so that, I will repeat the steps so that it's clear. Meanwhile, let me take the queries. Sir, in first method of probability, is we taking 33? Yes, we are taking 33. So basically here the probability of 33 will get calculated using this formula. Probability of 33 will get calculated. Probability of 27 will have to calculate basis the 100 minus thing. See, okay, let me repeat the valuation technique for binomial model. Binomial model, what does it say is that there are only two possibilities, either one or two. Both the possibilities, first of all, you calculate the payoffs. After calculating the payoffs, you have to calculate what is the probability. For calculating probability, there are two interrelated formulas. One is the equation form, one is the formula form. Both of them are derived from one another only. And this probability is calculated, or this probability is called as risk neutral probability, because this is not the actual probability. This is just a risk neutral probability. Actual probability can be something different, but this is for the same level of risk. What is the probability going to be? Correct. Hence, this is also called, the second part of calculating the probability is also called as risk neutral calculation for calculating the probability. Okay. Once the probability is calculated, then payoffs will be multiplied with the probability. We will get the probability adjusted payoffs. Those we will take a present value and arrive at the value of call option. Okay. So Namita is asking, sir, in second method, if we calculated expected price first, sir, in second method, if we calculated expected price first, then we know probability already. No, 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 no. See, both the things are independent. Calculating a probability is totally independent, and knowing the price is also independent. See, as per our estimate, we can estimate the price can go 10% up or 10% down. But what is the probability? That is a separate thing that has to be calculated. We don't know what is the probability in the initial stage, hence we have to calculate the probability. So Namita, your query will further get resolved once we solve one of the question, because from there it will be very crystal clear. Sir, how is then can we assume different upside or downside? Yes, yes, yes. Naveen is asking, sir, how is this 10% assumed? 10% I have just assumed to take the example. That's all. It can be 5%, it can be 10%, it can be 25%, anything. Yes, this rates effect. So don't go with this 10% as fixed. Binomial model doesn't suggest 10%. It says that the price determination has to be a separate thing. That we will cover from the question. Okay. So it will give you the two prices, the two chances, the price going up, price going down. Okay, students. So this is just for the example I've taken 10% here. Let us go to the question number 18. Yes. Now let us try to understand this question first. Okay. Now, students, read out this very carefully because this is all dependent on the thoughts that we have studied till now. Sumana wanted to buy shares of EIL. First of all, she wants to buy some shares of EIL. EIL would be some kind of a company. Okay, before this, going ahead, this 1 plus R, if this is there in case of a discrete compounding. Okay, students, in case of continuous compounding, this formula will look like as e raised to the power RT minus D divided by U minus D. This is somewhat similar to the continuous compounding that we have seen earlier. Yes, Naveen. So Naveen is saying, I mean, different rates for upside and downside. Yes, it can be. Upside can be 10%, downside can be 5% also. There can be different rates. It all depends how the facts are given in the question. And in real life also, it can be anything. Correct, Naveen? So what I'm trying to say here is that this will be replaced by e raised to the power RT if there is a concept of continuous compounding. Now, let us go here. Sumana wanted to buy shares of EIL, which has a range of 411 to 592 a month later. Okay. So we are given that EIL have a range of 411, 592 all after 1 month. This is the expectation. The present price per share is 421. The present price is 421. Her broker informs her that the price of this share can soar up to 522 within a month or so. She is given the information that this price can go up to 522, although the range is between 411 to 592. Okay. So broker is saying that today is 421, it can go up to 522. This is the fourth price that is introduced in the question. Nothing to worry here. Soar up means it can go up. Soar up means it can go up from 421, it can go up to 522 within a month or so. Okay. Now, what is the second part here? They're saying so that she should buy a 1 month call. They are saying she should buy a 1 month call on EIL because the prices are expected to go up. If the prices will go up, he will benefit out of Sumana will benefit out of that call option. Correct? Because the price is going up, she will gain through that call option in order to be prudent in buying the call. Now she is very prudent in buying the call because she has to incur some premium. So she's getting prudent and she is saying that the share price should be more than or at least 522, the assurance of which could not be given by her broker. So she is saying that, okay, I will buy it provided the price is at least 522. You give me an assurance, then only I will buy the 1 month call. Okay, this is also as a piece of information. Though she understands the uncertainty of the market, she wants to know the probability of attaining the share price of 592. See, now the question has totally gone away from 522. Okay, so big story was mentioned on 522, but if you see as of now, for calculating the probability, the question is saying you calculate the probability basis 592 so that the buying of 1 month call of EIL at execution price of 522 is justified. Now, here the question again takes a turn where it says that this 522 is a exercise price. Okay, so don't get confused. The upside price is 592, downside price is 411, spot price is 421. Okay, and the rate free interest is 3.60 and e raised to the power is given. That means the question is asking us to do the continuous compounding. And since this 3.6 is not given for which month, for which period, for 1 year, 2 months, 3 months, we can safely assume because e raised to the power 3.6 percentage is what it is given, right? So we can safely assume that this is only for that period for which we are calculating the 1 month. Basically, this is for 1 month. Okay. Now, I think you only can tell me what is the probability of price going 592. Correct? This is what the requirement is. Probability that the price will be 592 is e raised to the power RT minus D divided by U minus D, where e raised to the power RT will be is equal to e raised to the power 0.036 minus, because 3.6 percentage is the rate of interest. What is D? D is 411 lower price divided by current price of 421. Correct? 592 divided by 421 will be U divided by 592 divided by 421 minus 411 divided by 421. Okay. Now this is actually 1.037 that is already given in question. 1.037 minus 0.976 if we calculate this divided by 1.406 minus 0.976 is equal to 0.1418. That means 14.18 percentage is the probability that the price will be 592. Simple. Okay. Probability that price is 592 is 14.18 percentage. That's all. So now she knows in her mind that if the broker is saying that it will go up, she knows that 592, it can touch maximum 592, that too with a probability of 14.18. Now she will see her risk profile herself, whether she can take this much of risk or not, and then she will decide whether to buy the call or not, call option or not. Okay, students. Namita is saying, sir, as market runs on demand, definitely as the market runs on demand, upside and downside can be different. Correct? Okay, Naveen, thank you. So now let's go to the question number 19. Sorry. Yeah, now it's visible. So question number 19 says, consider a 2-year call option. Now see the 2-year call option we are assuming, okay, with a strike price of 50 rupees. The current strike price of 50 rupees on a stock, the current price of which is also 50 rupees. So the strike price, the current strike price, the current spot price is equal to strike price of 50 for a 2-year call option. Assume that there are 2 time periods of 1 year, and in each year the stock price can move up or down by equal percentage of 20%. Now, Naveen, please pay attention here. The question itself is saying you to assume that it's an equal percentage of 20 up and 20 down. So we have to do nothing. We have to go by this assumption only. Correct. The risk-free interest rate is 6%. That also they have given. Using binomial option model, calculate the probability of price moving up and down. Okay. And also draw a 2-step binomial tree showing prices and payoffs at each node. So first of all, what is this node called? Node is nothing but all the terminations. Let's say after 3 months, we draw that tree. After 3 months, that is called as node. So at each every node, we have to calculate the payoffs and we have to show the binomial tree. Very easy. Just follow this because this is the first question on binomial tree that we are doing. So first of all, we are talking about A node. This is the A node, okay, where the spot price we can put 50 rupees. Now from A node, this is actually year 1 and this is actually year 2. This is, let's say, B node and this is, let's say, C node. This is B node, C node. Now from 50, it can go up to 20% after 1 year, which is how much? 60 rupees. And from 50, it can go down to 20%. 20% of 50 is 10 rupees. So here it can go down up to 40 rupees. This is the price. Correct. And again, after 1 year to the second year, it can have 2 possibilities. 60 can go again plus 20% on 60 becomes 72. Minus 20% becomes 48. So let's say this is called as D node. This is called as E node. Now 40 will go up by 20%. So 40 plus 20% on 40 will be 48. So that means from here also the node will be common. So C for plus 20% it will be 48 and for lesser it will be F node, which will be 32 rupees. This is called as binomial tree. Okay, so we have taken the step-by-step calculation. After 1 year, B or C is the possibility. From B, there are again 2 possibilities, D and D. From C also, there are 2 possibilities, E and F. Okay. Can we calculate the payoffs also? Because we are required to calculate the payoffs as well. What is the strike price? 50 rupees. If 50 rupees is the strike price, the payoffs, let us mention here only the payoffs will be, I'm just putting the payoffs in a box so that it is different from the price. Here it will be 72 minus 50 is 22. 48 minus 50 will be 0. 32 minus 50 will also be 0. Why 0? Because there is no loss. It will be 0. Now this 60 minus 50 is 10 here. And 40 minus 50 is again 0 here. So only the payoffs will happen at B node and D node. E, C, and F, there is no payoff that will happen. Correct? Because the price is below the strike price or the exercise price. Also, to calculate probability of price going up by 20%, we can do 1 plus R. 1 plus R is 6% minus 0.80 divided by 1.20 minus 0.80. What is this that I have done? So this is nothing but the 20% it can go up or 20% it can go down. Or else instead of this, you can do like this as well. 40 divided by 50, 60 divided by 50 minus 40 divided by 50. Like that U and D that we have done. The result will be same, 0.8, 1.2, 0.8. It will be same, okay? What is the probability that the price will increase by 20% will come from this formula. So 1.06 minus 0.80 divided by 1.20 minus 0.80. Probability of moving the prices 20% up is this. And the probability is coming out to be 0.2 minus 0.8, 1.06 minus 0.8. 65%. So the probability that the prices will move up by 20% is 65%. So the probability of increase is 65%. Probability of decrease is equal to 35%, which is 100 minus 65. Okay, so we have calculated the payoffs. Now let us calculate the values. Calculation of values. Okay, students, till now probability is clear. Now let us go and calculate the values. So let us put nodes here. Nodes, first of all, D node. D node, what is the payoff? 22 rupees, right? So we can say 22, which is 72 minus 50 is equal to 22. This is in the money. Then comes E node, F node, correct? E node is what? 48 and 32. Yeah. 48 minus 50 is equal to 0 out of the money. Then 32 minus 50 is equal to also 0. This is also out of the money. Now see students, we have calculated the values at node D, E and F. Now what would be the value at node B? This one. It is not going to be 10. 10 is just a payoff, correct? On that particular time, if price is 60, the payoff will be 10. But what would be the value? The value at node B is the present value of probability adjusted D and E nodes. You're getting my point? Okay, let me just put it. 22 is node D, right? What is the probability of price going up? 65% plus 0 multiplied by 35%. 0 is why? Because E node is at 0. Whole divided by 1 plus 6 percentage. This is the present value that will come to node B. $13.49. Node C will have present value of probability adjusted values from E and F, correct? But E and F, both of them are giving 0 rupees only, correct? It will be still 0. Okay, now this is 13.49. So I'm just putting value here, 13.49, and this is 0. Now for calculating the value at node A, we have to take the probability adjusted values of node B and C and take a present value of it. So A is equal to 13.49. What is the probability of price going up? 65%, correct? From A to B, the probability is 65 plus 0 into 35%, which is, this is node C, divided by 1 plus 6 percentage. And this value is finally 8.272. So the value of this option should be 8.272 basis the binomial model, which is the node A value. I hope this part is clear, because from year 2 we have to come to year 1, and from year 1 we have to come to year 0, date 0. So Namita is asking, sir, you told in that second method we first calculate the expected price. So for calculating it, we have probability. So what we are calculating in second method? No. I'll tell you, just a second. Let this finish. Then I'll tell you. Okay, so this is all about question number 19. Okay, now Namita is asking that in the second method, to calculate the probability. See, I only told you that expected price is 33, which have a probability of P. That P we have to find out. Okay, Namita. So what I told is we have a expected, see, in the probability distribution, we get, okay, you can have different possible prices, right? What are those possible prices? 33 and 27. Now this 33 and 27 have probabilities attached to it, correct? Probabilities is, this is P and this is 1 minus P. If we multiply the probabilities in this and take a present value, it should be equal to the spot price. This is what is done in this equation. Okay, students. So with this, today's session also comes to an end. In the next session, we will cover the balance questions as well as the balance topics. I would request CA Ashish sir to conclude the session. Yeah, thank you, sir.
Thank you, Devas. Am I audible?
Yes, sir, you're audible.
Your session was a very brilliant session, because you have cleared all the concept in very detailed manner, especially binomial model. So, but during the session, I was seeing some queries were relating to some practical option aspect.
Yes.
So, as in the beginning of our class, we gave it normally a disclaimer that these classes are meant for academic purpose. Of course, option seems to be a very exciting one because of earning the huge money with no hard work. But please remember, be conscious, and as a teacher, I always advise a student during your CS studies, please don't indulge yourself with the this option trading, etc. Because as per Warren Buffett, the derivatives are the source of mass, are the weapons for the mass destruction. So just for the examination purpose, you consider on that, because there may be some difference in theoretical aspect and practical aspect. So it has also been observed that students sometimes have not followed the academic approach, rather they have followed the practical approach, and they have lost unnecessarily the marks. So student, my advice to you, please go by the procedural method what we has been covered in the study material, and please be limit to yourself up to that level only. Thanks very much a lot.
Thank you,
Now
sir.
your class will be day after tomorrow. Okay,
Yes, sir.
students. And I think option will be continued in that class also.
Yes, sir. Black Pulse model we will
Students.
complete.
Okay, students. So what I will discuss in today's class, you revise the same. And if you have any issue or any question, so please you mail us at sfm-final@ici.in, or you can contact me over the telephone. My telephone number is 0120304596. Student, my request to you, please, in these since examinations work is on my head, and my team is also involved in the same. So it will be better if you just send me an email along with your telephone number. Okay, wherever the top possible, we shall contact back to you. Okay, Divas, thanks a lot.
Yes,
Have a
sir.
nice
Thank you,
day.
sir.
Yes, thank
Thank
you.
you.
Okay, students, bye for your patience. Thanks a lot.
Yeah. Thank you.